Good morning and welcome this morning to Investing in Dividend Paying Stocks. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Scott Thompson, who is a 20 plus year veteran of the financial markets. He and I have been around here teaching this stuff for a long time. In fact, little known fact, he and I started doing this at exactly the same time. We're in the same new hire class. So Scott's been right there alongside this. Scott's there to help answer these questions that you might have that are flowing into the chat. Welcome to you if you're with us in the chat. Welcome to you if you are in the recorded version of this webcast as well. We're glad to have you either way. Be a part of the conversation. Chat in your questions, or if you're watching the recorded version, leave us a comment in the comment section. We'll get to that as quickly as we can. You can also follow us on social media. I'm at Ben Watson CS. Scott is at Scott Thompson CS out there on X. Scott just popped that out there into the chat. So I've been covering this particular webcast for a couple of weeks now, and I've got to say this. I've got a quick admission. Fundamentals are not my strong suit. I've never really spent a terribly large amount of time digging into fundamentals, but this has given me some insight and some idea about how I might use fundamentals. So thank you for coming along with this fundamental journey with me. You might know some of the things that we're talking about. You might know more than some of the things that I'm talking about when it comes to fundamentals, and especially when it comes to the area of dividends. But I'll tell you what, it comes to that point for many investors where you realize capital appreciation is good. Capital appreciation with a dividend paying stock is maybe better. So we're going to talk a little bit about that today. So let's do that as we get into this discussion, jump into a couple of these housekeeping items that we need to pay attention to. And because of one of these housekeeping items, that's kind of what sparked this particular question today. So remember, everything we talk about simply for illustrative and educational purposes only. It is not any kind of a recommendation or solicitation of a particular account or a strategy or type of investment. Any individual symbols that we look at, any information about those symbols is simply for illustrative and educational purposes only. Now, here is the discussion that sparked today's topic. There are risks associated with investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends. So that question, that statement in the disclosures a couple of weeks ago brought up a couple of questions in the chat, which were primarily about how do you know if a stock is going to continue paying dividends? So we're going to explore that. But let me continue with the disclosures here really quickly. We're going to talk some technical analysis. We're going to talk some fundamental analysis. Both of those are theoretical in nature. None of those guarantees about what the market is going to do in the future. They don't guarantee future performance or anything else. So Schwab doesn't recommend the use of technical analysis or really any sole means of analysis as the sole means of investment research. We're also going to be using the Thinkorswim desktop software platform, specifically the paper money version of that platform. We're going to be using schwab.com today as well. But the paper money platform does not guarantee future success. It's a good learning environment. There are some things that it does not do in the paper money version, like using studies in scans. So we'll have to kind of work around that. Remember also, of course, investing involves risk, including loss of principal, past performance, no guarantee of future results. And there's, as we talked about, things like diversification and dividends. Diversification doesn't ensure profit, doesn't protect against losses in declining markets. There is no silver bullet by any means. But I want to get into this topic of dividends. We're going to talk a little bit about dividend stock basics to a certain extent. We're going to talk about what the market is doing, and we're going to look at some stock trades as illustrative examples. But in order to get to that, we have to understand what it is that a company has to get to pay a dividend. Sam, I like that comment. And I think that comment has more insight than you know. And that is this. Sometimes I wonder if dividends are clickbait. Wow, that's really interesting. Clickbait. I get that. The idea that we've got this big bold headline that makes us think, cool, I want to dig deeper, and then it's unsatisfying, maybe at best, right? So, uh, clickbait in the idea that we get attracted to high dividends, and then the company underperforms that expectation, meaning it's a downward trending stock. We don't get capital appreciation. So we're going to see if maybe we can get to both of those areas here. So the first place that I want to go is I want to go over here to the Thinkorswim desktop software platform. And a couple of weeks ago, we did this Dividend Kings scan. We built kind of this chart that gives us the idea of an uptrending stock. It gives us an idea of when there's some upward momentum, when there's some volume increase. And it also has on there a couple of other tools, things like earnings announcements that are showing, and it has dividend announcements. Now, the reason I'm kind of focusing here on Coca-Cola, and Scott and I had this conversation yesterday because I happened to do the chat for his webcast yesterday evening, and I'll let Scott put the link to that webcast in, is because we were talking about Coca-Cola. Yesterday saw the breakout. Scott did an illustrative example trade in his webcast last night at about the same time that I was doing research for today's discussion. So we kind of came to the same observation about this particular stock. And again, not a recommendation, but from two different perspectives. I was looking at it from the potential for its dividend durability. Scott was looking at it from the potential for its durability of capital appreciation, or its uptrend, is another way to think about that. So two different ways that we get to the same discussion. So started thinking about Coca-Cola, seeing that movement to the upside. But let's go back to the original question, which is, how do we know that a company is going to continue to pay dividends? How do we know that it's not just clickbait, to Sam's comment, that we get the dividend once and then it goes away? Because that is a risk for sure. Conditions change. So one of those things is, maybe we look to lists like here in the Market Watch tab of companies that have been paying dividends. We're going to go to our public watch lists, companies that have been paying dividends for 25 plus years. This is what we would refer to as the dividend aristocrats. Did I call them aristocrats? Boy, there's my Disney background coming out, right? Aristocrats. I'm just going to call them I'm going to call them dividend aristocrats just for the sake of it's fun. And then we take a look at the list of 50 plus year dividends. And these are companies that have been paying dividends and increasing their dividend on an ongoing basis for more than 50 years. These are what we call the dividend kings. Sometimes it's good to be the king, right? So this is our starting point. We could just simply leave it at that and just focus our efforts right here in these particular stocks. But I think there's an idea of how we might want to evaluate this from that standpoint. It's cut off on the left side of the screen. Okay, stand by. Let me see if we can get that to fit, because I'm not sure why it's scaling that out. Let's see if we can reduce this a little bit. And let me do that really fast. Let's go to display settings, stand by one, and we'll see if we can get this figured out. And I think it may be just the scale. Stand by. Let's see if we can go. See if I can change the scale on that real fast. It's not been a problem before, but I just want to make sure. I wonder if something has changed. Stand by. We'll see if we can get that resolution down a little bit there. Let's go here. All right. There we go. That seems to work. Yes. We seem to have it now. Okay. Good. I'll see if that helps out. We can see both sides of the screen. Okay. All right. So long snapper, I get that. Dividend kings, dividend aristocrats. I mean, that's the starting point. But I want to go a little bit deeper into this. And this is, again, one of the questions that I had personally as I get to this understanding is, how do we understand whether or not a dividend is persistent? Okay. So there are three things, actually four things, that I kind of came to and understanding with my resolution, my research and resolution in learning this. So the first thing I want to see is I want to see a company's net income. And I want to see that net income be positive, right? That's a pretty good early sign that the company has that ongoing earnings potential to continue that dividend, right? To return value to shareholders. The second is free cash flow, right? Does the company have actual bankable cash that they can return parts of to shareholders? So net income, free cash flow. Then we kind of distill some of that down to the next part, which is earnings payout ratio. So earnings payout ratio. Net income, free cash flow, earnings payout ratio. The fourth thing in our four-step process, and I really kind of distilled this down, and I got to thank my friend Jessica Inskip. If you have ever seen her on the Schwab Network, which is brought to us by our media affiliate, Charles Schwab Media Productions. If you've ever seen her on one of our Market Drive events, she's been a guest speaker in that event on a number of occasions. So she does a lot with kind of distilling things down into the things that make the most sense. Last one is this one, free cash flow payout ratio. So net income is going to tell us, is the company earning money? Free cash flow is going to tell us, are they building a pile of cash? Is that likely to continue? And out of that pile of cash, can they satisfy dividend payouts? That's where we get to that earnings payout ratio. They're not paying too much out in dividends. And then the third one, free cash flow payout, gives us an idea that their cash reserves, that free cash flow pile that they're building, they're not burning into cash reserves. There's an adequate amount of cash on hand to be able to satisfy those dividends that are paid out. So here's how we're going to look for this. We're generally going to look for this. We're going to look for a positive number here on net income. We're going to look for a positive number on free cash flow. We're going to look for an earnings payout ratio that is less than 60%. And we're going to look for a free cash flow payout ratio that is less than 70%. So with those four metrics, positive net income, positive free cash flow, less earnings payout ratio than 60%. They're not paying out an enormously exorbitant dividend, and they've got the free cash to do it, and they're not uncomfortably dipping into cash reserves. Those are our four criteria. The problem is we can't find all of that information here on the Thinkorswim platform. So for that, we need to turn to schwab.com. So we're going to pop over here to schwab.com. We're going to do a little bit of research in the research section of schwab.com. So we're going to go to schwab.com. Now I'm going to start with Coca-Cola because that was the company that got me thinking about this to begin with. So we're going to pop in here into our symbol box, KO. And here's the Coca-Cola company. So again, there's going to be third-party information on this screen. Remember, those third parties, those are their own providers of information, their own opinions. They don't necessarily reflect the opinion of Charles Schwab. So we're going to scroll down through this information. The first place that we're going to go is step one, which is net income. That's kind of that accounting profit. Is the company making money? And we want to see positive net income. So the easy place to find this is if we scroll down through all of the information, and we're going to scroll down to our statements. And we're going to go to the income statement. That makes logical sense. At least it does for me, and not being a really fundamental kind of guy. So I'm going to click on the income statement, and we're going to scroll down here to, this is still the summary. We could dig down into the detail report here, but this information is available in the summary report. And where we're going to get to in this particular case is right here, net income. That's what we're going to be looking at first and foremost here in step one is net income. And we're going to be looking for the most recent information. Now, obviously, we're just past that first quarter of 2026, but that's going to be reflective of the trailing 12 months. So that's where we're looking at 2025 information that ended as of December 31st, 25. Okay. Now, Joe, we're going to get to some volatility discussions here in just a minute. But the first thing I'm going to look for is the company making positive net income? And so I'm going to go to this number right here, 13 billion in net income. And that's where we first of all say, all right, fine. This is a company that has positive net income. Cool. Passes our first test, which was positive net income. The second test is unfortunately a little bit more difficult to get to, because we've got to do a little bit of math here in this mix. We've got to come to free cash flow. So we got this whole cash flow statement, which is cool because it gives us some important information, but we've got to kind of tease this out a little bit here. We've got to come up with what that free cash flow is, right? So, long snapper, that's not one of our characteristics in this particular case. And I'm not, again, third party providers of information have their own opinions. So if I had made Schwab Equity Rating a category or a qualifier for this, then you're right. We might stop at that particular point, but we're not. We're looking at durability of the potential durability for the dividends. So how did I get to this? I went to the research tab on schwab.com. I typed in the symbol and I scrolled down this list of information down to our statements. So we started on the income statement. Now we're looking at the cash flow statement, right? So you're right. And Barbara brings up a point. 1 year of net income enough? Maybe longer info helpful for dividend stocks. And that is potentially. But remember, this is already a company that's in that Dividend Kings list. So they've got a pretty good track record. But you're absolutely right. If we can expand this. So I distilled this down to the most simple pieces of information that we can use as a litmus test, okay? As a litmus test to see what might be a predictor of, and again, remember, predictions do not guarantee what's going to happen, but a predictor of dividend durability. So we're going to go to the cash flow statement. We're going to open up that cash flow statement, and I'm going to open up more. So we're going to go to the cash flow statement. We're going to come up with a calculation of free cash flow, right? Yeah, I agree. Yeah. All right. So let's pop into this discussion. And again, like I said, many of you probably know more about this than I do. That's fine. You're here with me on this journey. Some of you don't. So that's why this journey is important as well, for sure. And you can always look deeper into the fundamentals. Thank you, Scott. So here's what we're going to do. We're going to talk about free cash flow. And so we're going to get to two numbers that we need to pay attention to in this particular discussion. The first is total cash from operating activities, or total cash from operations. There it is right now, 7.4 billion. Okay. So again, we're going to use that last piece of information as our litmus test. This is simple. We're trying to make this simple. We can always dig deeper. We're just trying to distill this down into one simple, or in this case, four simple metrics that we can use as a starting point. Remember, I want companies that have the potential for, or that likelihood of durable dividends, and that are also the possibility of giving us some capital appreciation by looking at uptrending stocks. So now here we go. We've got our total cash from operations. That's right there. And we're going to now find capital expenditures. Real simple calculation. We're going to take total cash from operations and we're going to subtract from it capital expenditures. Okay. And the reason that we're coming up with this piece of information, is simply this. That's going to give us the tool to come up with that free cash flow payout ratio. So let's just do the simple calculation here really quick. Let's go to the math. So I'm going to pop up a calculator really quick. And let me bring that calculator up to our page here. 7408 minus 2112 gives us free cash flow of 5,296,000,000. Okay, that's where we get to our free cash flow. Now that we've got that number in mind, I'll just pop this back down so that we can kind of keep that as a notepad. The next thing that we're going to get to here is we want to get to that earnings payout ratio. So we're going to scroll back up in this list. We're going to close that one down, and we're going to go to the dividends section of this fundamental research page, and we're going to open this up. We're going to click on Show More. And once we start to open this up, we're going to come over here to the right-hand side, and that gives us some information that we need to pay attention to. Again, our third characteristic, right? So first one is net income. Second one is cash flow. And do we have positive cash flow? Third is that dividend payout ratio. So we're going to come over here to the right-hand side. And that dividend payout ratio, again, trailing 12 months. This is 64.7%. And you remember, if we pop back over here, that our earnings payout or our dividend payout ratio was this, less than 60%. Okay, less than 60%. So we're a little bit high in terms of that payout ratio. However, one thing to note about Coca-Cola is they had a special dividend. So that was a special circumstance, and that can be a possibility. But generally, that earnings payout ratio in this particular case, we want to see less than 60%. They're not paying too much out in dividends. So now we're going to pop back over to Schwab.com. Now that we've got that information, we've got those three tools in place here, that gives us some semblance. Now we've got 3 out of those possible. Now what we've got to do is we've got to come up with the final part of this litmus test. And for that final part of the litmus test, we've got to go back to the statement here. Back to these statements. We know what our free cash flow is. The last of these 4 criteria is that free cash flow payout ratio. So in order to get to this, okay, in order to get that free cash payout ratio, we've got to go back to our, close this one down. I probably should have put those in a different order, but that's okay. We're going to come back to our statements. We're going to go to our cash flow statement. We're going to open that up. And we want to see the total cash paid for dividends. Okay? Total cash paid for dividends right here. Total cash dividends paid. 8,779,000. So here's what we want to do. Is we want to take that total cash. So let's come up with our calculator again. Let's clear that. And we're going to take that 8,779, right? And we're going to divide that by our free cash flow, which we said was 5,776. Our free cash flow payout ratio is a little bit higher than we want it to be. We want that to be less than 70%. So they're perhaps burning a little bit of cash reserve to get to that level of dividend payout. That may be the reason, going back up in the comments, why we're seeing those ratings that might be less than desirable for a dividend paying company. Now, while we think, cool, this is a company that's been in the dividend kings and paying those dividends out. Yeah, you're absolutely right, Sam. That kind of dividend is going to require something to get that capital appreciation. So going through this process helps us to start putting this into perspective. because this isn't digging completely into all of the information. This is just giving us that litmus test. So now let's kind of go through this process once again. I thought maybe we could streamline this a little bit. We could go through this in each one of these stocks that we might be looking for. But I thought maybe we could make this a little simpler. And the way that we can maybe make this process a little simpler is create a scan that looks for these characteristics. And the cool thing about the scan is we can get to some of these things that we couldn't get to by just looking at the statement or pulling out individual ratios. So I went over here to the research tab once again on schwab.com, and I went to the stock screener. So we went to stocks, and I went to the stock screener, and I built a scan looking for these 4 criteria. And it actually gives me the ability to build a couple of other things into this mix. So let's go to this scan. I already saved it here as the dividend durability screen, but let me take you through the characteristics that I put in this screen. So over on the left-hand side, the first thing I chose is one that you could leave in or you could take out of the mix, and that is market capitalization. So as I built this scan, the first characteristic that I put in this list was I want to see large cap stocks. And the reason for having large cap stocks in there is generally a precursor to persistence or dividend durability, if you will. It doesn't guarantee it by any means. But if you like using small cap stocks, if you like using mid cap stocks, if you like using a particular industry group, this is where in that basic section you can change that. Now we're going to come back down here to the dividend section. So there's a couple of things that I want to have in this search. Again, distilling down that information and hopefully addressing some of the questions that you asked. Well, wait, maybe do we need a little bit longer persistence of that? So the first one that I went to was payout ratio. And this is earning per share return to shareholders in the form of cash dividends. So that was our earnings payout ratio that we looked at in our 4-step litmus test. Okay. I looked at dividend yield for persistence of yield, the average of the dividend yield over the last 60 months. And I wanted to specify that in a particular level. And our 5-year dividend growth rate. Again, I want to specify that this is growing the dividends over time. So here are the characteristics that we have. We have a payout ratio that is less than 60%. We have a dividend yield between 1.5% and 6%. So we're not going to have those big, extraordinary special dividends, nor are we going to have dividends that are maybe less desirable on an ongoing basis if you're looking for income coming in from dividend payouts. Now, we've got a current ratio, which gets us pretty close to that free cash flow and other instruments here in terms of that movement that gives us the idea that perhaps this company is not burning cash. They have the free cash flow pile to satisfy that ongoing dividend payout. So to that, we went to financial strength, current ratio, and debt to equity. Is the company saddled by a lot of debt, or are they growing their equity relative to their debt? So the characteristics that I set for those: debt to equity, less than 100%. They're not over leveraged. Current ratio, greater than 1.2. So with all of those characteristics in this mix, I ran that search. And we've got those current results here. And in this particular case, I think we came up with let's see if we can run this screen again. I'm just going to save this once again as my dividend durability screen. We're going to override that. And let's go view by screen criteria. There's our screen criteria right there. And we have 28 matches. So we're viewing all 28 of those matches. As we scroll up this list, I'm not seeing Coca-Cola on this list at all. So it didn't meet our characteristic. Interesting. So one that we thought that sparked the conversation filter into all this. Again, none of this is a guarantee, but we've got some stocks in this list that might be of interest in terms of now determining, is there the time to get into that particular stock to see that capital appreciation along with dividend persistence. So what we've done, all I simply did was come up with a 4-step litmus test, converted it into a scan with a couple of other characteristics, i.e. the market capitalization and debt to equity, which I added in, which is a little bit harder to do in the Thinkorswim platform. And now we've got a couple of potentials here in this list. So I'm going to bounce back and forth, and we're going to take a look at a couple of these in this list. We'll build a short watch list of these particular stocks. So I'm going to take a few here. I'm going to take Barrick. I'm going to take Caterpillar. So I'm going to take Barrick. I'm going to take Caterpillar. I'm going to put FedEx in that mix. I'm going to put Corning in that mix. And I'm going to take one that maybe has a little bit more technology exposure, and that is Qualcomm. So we've got those 4 in the mix, 5 in there. Barrick Mining, Caterpillar, FedEx, Corning, Qualcomm in this mix. So we're going to pop back over here to the Thinkorswim platform, and I'm going to come down to my watch list, and I'm going to build a watch list here. We're going to create a watch list really fast in this list. We're going to call this our dividend scan results. And I'm just going to pop those into that list. That was Barrick and CAT and GLW and FedEx and QCOM in our list. Okay. Yeah, and I agree, Sam. You're right. It doesn't vary much over time. I guess that's kind of the point, isn't it? But now that we've got those in the list, I'm going to go ahead and I'm going to click on save, and we're going to pop over to this chart. And this chart is one that I built. This Dividend Kings scan check is one that we built a couple of weeks ago, where we've got a linear regression line, and we've got the price. We're looking for the price of the stock above that linear regression line. We're looking for that linear regression line to be moving up. We want to see positive MACD momentum. We want to see a volume spike, or at least getting to average volume. So now let's take a look. We've got our personal watch lists here. Let's pop down and select our personal watch list, which is our dividend scan results, and it's right down here. Dividend scan results. There's the stocks that are in our list. Let's choose the first one on the list and pop it into this mix. So now that we've gotten to this point, right? Now that we've gotten to this point, we're looking for the possibility of upward movement. Is that a characteristic? Are we going to see capital appreciation? So Long Snapper says not much income potential. So that's why we're looking for that possibility of upward movement. So we're trying to balance durability plus upward movement. Again, this is not any kind of a recommendation. These never are. This is simply an illustrative process of how we get to an understanding. So Barrick Mining, moving down, it's in a short-term, maybe sideways trend, but it's below its linear regression line. It doesn't have positive momentum, so we're not going to enter on this, all right? And you're absolutely right. Probably a little bit late, looking maybe for an upward movement here. So let's go to Caterpillar. Caterpillar next on the list. So we are right at that linear regression line. We've got positive, maybe positive momentum on the MACD, or it has been recently. We've got an uptrending line here. So we're going to put a pin in that one for just a second, come back to that, because we could set up a buy stop order on this. Now we're going to come down to FedEx. FedEx, same thing. We don't quite have that positive momentum on the MACD, but it is at that point where it could potentially break out. It's right at that linear regression line in an upward trending environment. And GLW, right at that linear regression line, not quite there yet. still below that 50, or that in this case 50 period moving average. Volume's been falling off a little bit. Momentum's been falling off. Qualcomm, on the other hand, don't have positive momentum, but it is above that linear regression line. So none of those 4 or 5 really got to that level. Okay. But let's go back to Caterpillar. And that was the one that we were looking at as a possibility. So notice the trend upward in MACD. Notice the trend upward in the price and this level of resistance overhead. Now, this is a relatively high price stock. So Barbara asks a question, quick explanation of linear regression line. A linear regression line is simply taking statistical range and defining a line or a curve that matches, that's this linear regression trend line, that matches the midpoint of that statistical range in which prices have been. It's like creating a moving average, but it's doing it using standard deviation as opposed to closing prices. So that linear regression line gives us an approximation of trend, a way to view trend in this particular case. How you get to it, Flask icon, LINEAR, linear regression trend line, and then we put that on the chart. So I've got my linear regression trend line on the chart. So we got that price starting to move up. We're right above that, or right above the 50 period moving average, right below the linear regression line, and right below a level of resistance. So here's my thought. As this gets to that level of resistance overhead and potentially breaks out, that's very likely going to put us in a position where that MACD momentum has now moved from negative to positive. In order for us to get that breakout above the resistance level, very likely that momentum has to be higher. So I'm going to put in a buy stop order here. Now, here's the idea. I might get into the stock when it's at a lower price, but I want some confirmation here as well, just like we did with the fundamentals, some confirmation that price is in fact moving outside of the range in which it has been. So I'm going to put a buy stop order here on this trade. I'm going to right click and we're going to create an order to buy this stock with a stop. And I'm going to create this as a buy stop order. So I'm going to change this order from a limit to a stop. And let's just come back down here. I'm going to zoom in a little bit. My resistance area is up here around 935 or so, kind of best fitting that resistance level. I'm going to say when we get up above 940, that's the point at which I want to enter that trade. So I'm going to make this as a buy stop at 940. Yeah, I could get into it at a little bit lower price, but that's not quite the point here. The point is getting into it when I've got a confirmation that it's likely to move a little bit higher or likely to continue to move higher. So I'm going to make that good till canceled. But that's a buy stop. It says stop, wait. Don't get into the trade until it breaks above that level. Now, I'm going to put a stop on this as well. And that stop in this case, I'm going to base on, at least at the outset of the trade, I'm going to base on this level of support that's been in place for some time. So I'm going to zoom back down. This range that the stock has been moving in for the last quarter or so sits at about 851. So that's where a break of that level becomes relevant. And yes, there's a fair amount of risk in this trade. 851, that's going to be my initial stop into this trade. But as this continues to move higher, I'm going to adjust the stop to follow. You know where there's a great way to learn more about these particular concepts? The stock investing webcast that Scott teaches on Wednesday evenings. I'll let him put the link in there again because he goes through this in some very specific detail of how to put this type of trade together. So I've got a buy stop entry and I've got a sell stop exit, protecting this if in the event it goes down. Now, there's no guarantee about where either one of those orders is going to get filled because they create marketable orders. But I'm simply approximating where I want to get into the trade with confirmation, where I want to get out of the trade if it's going against me. And I'm going to put this in confirm and send, and I'm going to put this down in my stocks group so that I can keep track of it. we'll fire that order off. We might not get there today. We might not get there this week, but this is that particular perspective. Now, Long Snapper says, wait, this is a long-term dividend stock. Why not just jump in now and do it with no stop? Well, we could. You sure could. Absolutely. The reason that I'm doing it this way is this fits my methodology of wanting to see an uptrending stock that's got some likelihood of capital appreciation and looking for an opportune time to enter the trade where there's confirmation, just like we did confirmation using the fundamentals of the likelihood of the persistence of dividends. We're using technicals to give us confirmation of the likelihood of the persistence of an uptrend. So if we're going to do due diligence when it comes to dividends, why not do due diligence when it comes to the trend as well? Not that it guarantees by any means, but it gives us an idea that that price may continue to move higher. So that's what we've come up to. Let me just kind of reiterate that. Net income positive, free cash flow positive, earnings payout ratio less than 60, free cash payout ratio less than 70. That gets us to our litmus test. We got to that by running the scan. We then looked at this particular stock based on its technicals, and that's what got us to this potential investment by using a combination or a fusing of dividends, fundamental information, and what we see on the technical chart. So that's one way to approach it. It is not the only way to approach it by any means, but it is simply one way that we can get to this particular perspective in understanding what's going on. So so you can use both Schwab.com to do this, as well as the Thinkorswim desktop software platform. So let me pop back over here really quickly. I wanted to give you some additional resources really fast. And we're going to pop into our Trader Talks webcast page right here. If you want to learn a little bit more about dividends or linear regression or any of the other tools that we talked about, just type it into the search box here. So I'm going to type in linear regression, and this should take us back to that. Let's see if we can get to that. There we go. Linear regression line tools. Here's the one that I did a couple of weeks ago. Linear regression tools for trend is the way that we can approach it. Trading the trend, emotions versus statistics, linear regression. So that's where you might go for some of those additional resources. All we ask is that when you get here, click on subscribe, and that's going to take you to, that's going to make it easier for you to find this information. It's also going to make it easier for other people to find the information as well. We'd love to have you click on that subscribe button if you haven't already. By the way, I've noticed that there is a feedback survey out there in the chat. I just barely noticed it. So it is out there in the chat. Do me a favor, help us out. Help us to make these webcasts better, to continue this great flow of information that's out here in the Trader Talks webcast page. My thanks to Scott Thompson for helping out. My thanks to all of you. Help me out by filling out that feedback survey. And check out the Trader Talks webcast pages here and all of the available webcasts that are recorded. This is going to be recorded. This is being recorded. Will be available shortly. But once again, thanks for joining me. Thanks for joining me on this journey through understanding a little bit more about both fundamental analysis and technical analysis. We'll see you again soon. Take care, everybody.